Morning, guys. It's Thursday, March 20th, 5:24 a.m. Central Time. Grain markets are mixed this morning. May corn futures up 1.5 at 463.5. May soybeans down 3.25 at 10.05. May Chicago wheat down 2.75 at 560.5 last trade. May Kansas City wheat down 3.75 at 591. May spring wheat down 0.5 at 611.25. We've got this ship fee story. Let's start there.
We sure do. President Trump's proposed fees on China linked ships are impacting U.S. agricultural exports. Trump is drafting an executive order to impose fees of up to $1.5 million on China made ships or fleets that include China built vessels when they dock at U.S. ports. The massive fees aim to boost domestic shipbuilding, but they have created uncertainty for agricultural exports. Exporters have struggled to secure transportation for corn, soybeans, and wheat beyond May due to uncertainty over final costs. According to the Farm Bureau, bulk agricultural exporters could face an additional $372 to $930 million in annual transportation costs and fees. The potential port fees have also limited the availability of ships for transporting energy, mining, construction, and manufactured goods to international buyers.
Mackenzie, this is not the first that we've discussed this. It was about a week ago.
Yep.
Okay, so now the new news is that there's potentially some impact on exports moving forward because these exporters and importers in China, they don't know what their cost structure is going to look like because they don't know if this is going to happen or not. You mentioned a couple of statistics from the Farm Bureau. They went into a little bit more detail on their website. They said this: on a per unit basis, these compounded fees translate to an increase of 9.5 to 27.8 cents per bushel of soybeans, representing a substantial margin loss in global markets where competitiveness is often determined by mere pennies per bushel. So this is almost like a self-imposed like tariff type thing. I mean, it's going to make it more difficult for U.S. exporters to compete in the global export market. And granted, every U.S. ship of soybeans is not of Chinese origin. It's probably split down the middle. Probably half of them are U.S. ships. Probably half of them are Chinese ships. I don't know exactly what the breakdown would be. With regard to the tariff, so China's got like a 10% tariff now on U.S. soybeans. But keep in mind that like the Chinese state soybean buyers buy soybeans, and if they need them from the United States, they don't have to charge themselves the tariffs. So they could still, this could be like an even bigger deal than the tariffs in some ways. I mean, because if it goes through, that's like a guaranteed, 15 to whatever they said, you're 9.5 to 28 cents less competitive we're going to be on the export market. I guess the timing, if you wanted to say something nice about this, is that we're not supposed to be competitive versus Brazil this time of year anyways. So if this is something that we can like, maybe it happens for a couple months and then they get over it. This is the time of year that you want it to happen. You wouldn't want it to happen like during the post-harvest time slot when we ship a lot of beans. I think our next story is perhaps tied to that.
USDA's China attaché office lowered its forecast.
Attaché. It's French. It's French.
Attaché
We're doing
office.
French lessons this morning.
Yep, and it's going well. Lowered its forecast for the country's soybean imports yesterday. The office estimates Chinese soybean imports at 106 million metric tons this season, down 2% compared to last season. The decline is driven by Chinese consumers increasingly shifting from pork to cheaper protein options like poultry and seafood as the nation faces economic headwinds and slower growth. The office reduced its forecast for soybean production to 19.8 million metric tons, a 4.1% decline versus last year. The decline is attributed to depressed market prices over the past 2 years at harvest. China continues to support domestic soybean production through government policies and subsidies to become more self-sufficient.
I think this trend is very troubling. And what's the trend? The USDA office in China is projecting that we'll see a second consecutive year of declining Chinese soybean imports. And that's a big problem because, and this is an older chart, but because Brazil continues to produce more. So Brazil is going to have 170 million metric ton crop this year. USDA projects they're going to export 105.5 million metric tons. You could get to a point, I suppose, where Brazilian exports actually like basically equal Chinese imports, or maybe exceed them, or maybe that math doesn't work because China's not importing enough. I don't know, but the problem is that you've got your biggest soybean importer contracting with regard to demand, and you've got your biggest exporter or producer expanding when it comes to production. We talked about the same thing with corn and wheat yesterday, and how the Chinese imports of corn and wheat are declining. And that's not as big of a deal. When you look at the top 10 corn importers this year, China is very low on the list at 8 million metric tons. If this were 2 years ago, they would have been at the very top of the list, but they've gone down quite a bit in terms of what they're importing. Same thing with wheat. They're kind of low on the list, but soybeans, China is the deal. 61% of all global imports, 109 million projected for this year. But again, the attaché office in China talking 106, and it's a disturbing trend if they're correct.
Ukrainian President Volodymyr Zelenskiy has agreed to a mutual halt to strikes on energy facilities. The agreement was reached during a call on Wednesday with President Trump, marking a shift in tone just weeks after a tense exchange between the two leaders in the Oval Office. Trump promised fresh support for Ukraine during the call, including potential air defense systems. Trump also had a friendly call with Putin earlier this week, where he also agreed to the terms of pausing attacks on energy facilities. However, Putin showed no signs of letting go of his demand that Trump's proposed ceasefire includes stopping weapons and intelligence aid to Ukraine and allowing Russia to keep the land it has taken in the war.
So I was told that, again, wheat prices were lower yesterday because there's going to be a ceasefire, and nobody has been able to explain to me why wheat prices have been so wheat has trended lower for 2.5 years while the war was going on. And now I'm supposed to believe that, oh, the war's ending. It's even more bearish. It's even more bearish than when the war was going on and we dropped, $6 per bushel in wheat prices. I don't know, guys. I don't know that I buy that story. In any case, the wheat market, it bounced a little bit. There is some rain in the extended forecast for U.S. HRW wheat country, like out past the last day of March into the first day of April. Maybe that's something. I've talked about it before. I feel like wheat at $6 is underpriced given what I know about supply and demand. But then again, the wheat market has never made any damn sense to me in my career. So you got that.
So if you guys have not checked out our premium content, you sure need to do so. Joe, can you tell me about some of our premium videos this week?
What you guys need, if you're a farmer or you're an end user of grains or you're involved in the commodity business in any way, shape, or form, you need independent, unbiased news. And that's what we provide here. So you might listen to some of the ag radio shows or whatever, and it's like half commercials. We did 40 minutes uncut of grain marketing discussion with Matt Bennett yesterday. It's absolutely fantastic stuff. And the bad thing about it is that you have to pay for it. But guess what? We put this stuff out every single day. We work our asses off doing it. And the only way that we can do this while maintaining our independence and not having sponsors is by offering a premium subscription that you have to pay for. So if you want the best information that's out there and you want the independent and unbiased information that's out there, I'm sorry, but you have to pay for it. I would love to work for free. Maybe someday I will. Not today. Go to standardgrain.com. It's $50 a month. You can sign up today. This is an absolute piece of cake to do. You go to the website, you sign up. It takes 30 seconds. You do Apple Pay, Google Pay, Cash App, whatever. You get on our email list. Everything that I talk about, all the premium videos, all of our graphics, they're super easily accessible on your phone. So if you guys are busy, you're preparing for planting, you're doing field work, whatever, you can do this all on your phone in 30 seconds. You get all the info on your phone in 30 seconds. Maybe you're going to need to listen or watch some sort of content while you're working this spring. This is a good place to start. So give that deal a shot, guys.
The Brazilian Association of Vegetable Oil Industries lowered its soybean production forecast. The lobbying firm projects this season's crop at 170.9 million metric tons, down from its previous estimate of 171.7. In comparison, Brazil's crop agency CONAB estimates the crop at 167.4 million metric tons, while the USDA has the crop pegged at 169. Well-followed private group Ag Rural reported earlier this week that Brazilian farmers have harvested 70% of this season's crop. The lobbying firm also increased its forecast for Brazilian soybean oil exports by 27% to 1.4 million metric tons, citing weaker domestic demand.
So you've got some disparity. Some of these private groups are higher, some of them are lower. USDA is at 169. I wouldn't think about this too hard right now. Harvest is ongoing. Maybe you get into the south and some yields will be poorer, but I'd probably just call it a 170 and forget about it and go about your day.
U.S. ethanol production was strong last week. Weekly output of 1.1 million barrels per day was up 4% on the week and up 5.6% versus the same week last year. Ethanol stocks were pegged at 26.6 million barrels. The print was down 2.9% compared to the previous week, but up 2.2% compared to the same week last year. Implied gasoline demand was down 4% week over week, but up slightly versus the same week last year. On average, over the last 4 weeks, implied U.S. gasoline demand is down marginally compared to the same period last year.
Ethanol production is fine. This is a good number. You may make the argument that USDA could come up slightly with its corn for ethanol projection for this year. The better news, I think, is that ethanol stocks are drawing down. And we had that like super high stocks print for a couple of weeks, and now we're coming back down, which is great. We don't need ethanol stocks in COVID territory, which is where we were. We need to draw them down, and we probably will. Seasonally, it would be totally normal to draw down ethanol stocks through call it like the first part of July. So I hope we trend in that direction.
The Federal Reserve held interest rates steady on Wednesday as it continues to assess the economic impact of Trump's policies. The Fed maintained its benchmark interest rate at approximately 4.3%. 11 out of 19 policymakers now expect at least 2 rate cuts this year. Citing the effects of proposed tariffs, the agency raised its inflation forecast for the year to 2.7%, up from its previous estimate of 2.5%. However, officials anticipate inflation to begin to decline in 2026 and 2027. The Fed revised its GDP growth projection for 2025 to 1.7%, down from its December estimate of 2.1%. The administration's tariffs, deregulation efforts, and energy policies have contributed to increased uncertainty surrounding the economic outlook.
Donald Trump, of course, had to chime in on this yesterday, and he did on Truth Social. He said the Fed would be much better off cutting rates as U.S. tariffs start to ease their way into the economy, do the right thing. Trump doesn't really have the ability to change interest rates directly, but his policies do. And if the tariffs really are inflationary, then it could lead to rate cuts. But that remains to be seen. We're in the very early innings of this tariff situation. What did cattle do yesterday?
Cattle futures were higher once again. Live cattle were 52 cents to $1.85 higher. Feeders saw gains ranging from 137 all the way up to 242. Choice box beef had a big day yesterday, gaining $6.29 at 329.61. Select was down 55 cents at 308.68.
The stock market rallied sharply yesterday on the Fed news, but it's right back down this morning. The Dow's down 260. S&P's down 40 points. Bonds are up a little bit. U.S. dollars up a little bit. Crude oil is down 10 cents in the May WTI at 66.81. Have a great day, guys. We'll be back on Friday.